From October 2025 to March 2026, the Hong Kong-listed green power sector loomed pretty bleak, with leading companies like Longyuan Power and Datang Renewable Energy seeing their price-to-book ratios drop to 0.5 to 0.8 basically. Selling high-quality assets at half price, the market seems panicked, but the main pressures are threefold: the cancellation of tax incentives, falling electricity prices, and the difficulty of collecting hundreds of millions in subsidy arrears. These challenges have weighed heavily on operators, making investor sentiment extremely negative. But while everyone focuses on the shadows, there are several deep changes happening that the market is largely eyeing. The first is the potential cash flow reversal from debt resolution. For arrears debt has been a major problem for green power companies, restricting operations and investment as some companies advance debt restructuring and optimize financing. Cash flow improvement is expected to gradually show up, relieving balance sheet pressure and allowing businesses to maintain stable operations and continue investing. The second is the reconstruction of business models through energy storage combined with capacity pricing. Traditional green power operations mostly rely on selling electricity, which has limited profitability, but with energy storage technology and the introduction of capacity pricing, operators can earn extra revenue during peak periods and for critical load adjustments. This doesn't just increase revenue, it fundamentally changes profit models and investment return timing. The third factor is the true realization of green certificate value. In the past, green certificates faced price volatility and policy uncertainty, making investors worry about inconsistent returns. But as trading mechanisms improve and companies optimize long-term holding strategies, the value of green certificates is gradually being recognized. It can improve revenue structure and support financing and valuation. When we put these developments together with current L/P/B ratios in Hong Kong, the question arises, is the 0.5 PB really a value trap or a golden opportunity? The answer may already be quietly emerging and verging. Investors need to focus on these expected differences, the gap between market perception and actual business improvements, which is the key logic for finding potential opportunities. Looking at Hong Kong green power, the short-term pressures mainly come from tax adjustments and declining electricity prices, which are external factors companies can't change overnight. But in the long term, companies are improving profitability through management optimization and debt restructuring and technology investment. These internal changes are all often overlooked by the market, creating undervaluation opportunities. This PX phenomenon isn't unique to Hong Kong. Similar patterns exist in the A-share market, where comparable companies show low PB levels and financial fundamentals that may be gradually recognized over time. Combining energy storage and capacity pricing implementation, future green power revenue elasticity will increase. What used to rely solely on electricity price fluctuations will now have a more robust business model, and cash flow will stabilize. This means the basis for valuation is changing. The realization of green certificate value is another underestimated aspect the market may not yet fully appreciate. How green certificates impact a company's balance sheet, cash flow, and PR profitability. As this value is gradually reflected, the gap between market Expectations in reality will narrow and low PB companies may see valuation recovery. The overall risk-return profile of the sector is shifting. Investors who can identify these differences in advance and position in high-quality companies stand to gain long-term rewards. This is what cold thinking and investment is about, not chasing short-term swings, but using data and logic to identify overlooked opportunities. Investing is not just about looking at that present, but understanding trends and structural changes. Hong Kong Green P. Our may look miserable now, but underlying structural improvements are happening. Low valuations combined with high potential create a unique window for our long-term investment. The key is patience and understanding the deep logic behind cash flow, business model reconstruction, and policy implementation. Rome feeling bleak to hiding opportunities. The sector's future growth may already be quietly unfolding. Those who can recognize these expected differences understand debt resolution, energy storage, plus capacity pricing, and real value of green certificates will be in the best position to capture value when the market eventually rebounds. This is the kind of thoughtful analysis that separates short-term panic from long-term opportunity and shows here real investment value lies.